Scott Martin, Kingsview wealth management kind of guy. Look, we've got the cavalry coming in, big time, from the government, spreading the money around all over the place. Is that going to put a bottom on the market?
Eventually it will, Stuart. You're right. The money is flying and flying fast out of many, many helicopters. You know, they used to refer to Ben Bernanke as Helicopter Ben. This is going to be helicopters, Trump, and Mnuchin. But it is the right thing to do. I think one problem, though, Stuart, that we've seen, if we take a clue from the market so far, is it's not enough. The money has not been very impressive, I think, from the standpoint of Wall Street's appetite. And so as they continue to maybe refine and, readjust these helpful notes that are going to be coming out of D.C., I think that's when the market may finally realize that help is definitely on the way here.
Okay, Scott, what does Wall Street want? I mean, if they're looking at the administration and saying, hey, what are you going to do for us, what do they want?
Well, I think they want one of two things, and one of them is not very great, but it might be the best. And I'll tell you what that one is in a second. I'll bury that lead for a minute. The first thing is, Stuart, is that Wall Street wants trillions of dollars of backstopping on, say, some of these bank loans. The Wall Street wants trillions of dollars, and I hate to say those words, of backstopping in the mortgage market. I mean, I talked to a couple of very, very smart mortgage traders yesterday at some major mortgage companies in the country here, and mortgages just aren't trading right now. I mean, nobody wants to buy or sell.
Okay, we've got a problem there with the... okay, I've got a problem with the transmission right there, so we'll try to fix that up. Scott Martin, I hope we've got a good connection back with you, but come in, please. We're hearing some dreadful economic numbers. Is that helping to push the market down and stopping a bottom being formed? Because these numbers are going to get worse, Scott.
They are, Stuart. The market kind of knows that, though, already. I mean, a lot of this data that we're seeing that is very bad, as you all discussed, is already kind of, I think, interpreted by the market. The question is, does the momentum pick up to the downside, or do these eventually bottom out at some point? And that's why, just as investors, we have to remember that stocks will likely front-run any kind of economic malaise or any kind of economic growth, too. So just as quickly as this is falling, just as bad as it looks, remember that when we get to the other side of this, the market will bounce back and bounce back strongly in anticipation of that economic rebound.
Yeah, we just don't know when. That's the problem.
I think the biggest issue, maybe not so much from the banks, we go back to 2008. The issue now is how many presumably healthy companies out there are facing a collapse the longer this goes on. We don't know.
No, we don't know.
And that is the biggest problem here.
So, Scott, I'm sorry, Mike Murphy, it's just awfully hard to find a bottom for the stock market when you don't know how far down the economy is going to go. That's the whole problem here, isn't it?
It is, Stuart. And then you have to add to the equation the potential for bankruptcies out there. That last time I was with you a week ago, we weren't talking about potential for massive bankruptcies. So now you have to put that in the equation. But I want to stick to this point, though, Stuart. Finding a bottom is not the goal here, because none of us are going to find that. The bottoming out process will come, and, we're down 2.5% today, roughly. We could be going through that process as we speak. So for investors at home, the one thing you don't want to do right now is start reading headlines that tell you the world is going to end and liquidating after a 35% drop in your holdings and then missing the entire turnaround. A turnaround will come. Where a bottom comes, I'm not sure. But people watching at home, it's not pretty, but you have to ride it out. And if you have money, put it to work in quality names. Do not sell into this type of sell-off.
Now, I'm going to quote Treasury Secretary Mnuchin, who was on with Maria just literally a half hour ago, and he said, look, we will destroy this virus and the economy will come roaring back. That's exactly what he said. So, Scott Martin, does that mean when the economy comes roaring back, does the stock market come back in a V, in other words, straight back up again, or is it an L, all the way down and then flat as she goes? Which is it, V or L?
It may be a letter, Stuart, that we haven't seen yet. I think it's going to find its own way. I mean, I think that's really the tough part about this. Yeah, it could be an H. Because, Steve Mnuchin and the government officials, God bless them, have to say things like that. I mean, otherwise, if they came out and probably really said what they thought, we'd be even more scared. But the reality is this, as I said earlier, There's trillions of dollars coming into the system here. Whether the amount is enough for the market to be confident that it's going to fix the problem, that's really the question. Because to your question to Mike Murphy earlier, one of the indications to me, guys, that we're not finding a bottom yet is the fact that credit markets are still very misbehaved, like my children some days. So the reality is until credit markets stop seizing up and we get that free flow of, say, corporate credit, mortgages, bank credit, things like that, bank loans, those things have to shore up and get fixed before the market can heal itself on the equity side.
Okay, I just want to throw this one out, which I've not heard this reported, I've not heard much commentary about it, but one of the great things that comes out of this worldwide global slowdown is far lower carbon emissions. The virus is doing more for the environment than the 20,000
The canals of Venice are clear now. You can see fish going around.
But if you damp down on economic activity all around the world, and that's exactly what we're doing, the factories are closing in China, or maybe they're reopening now.
Economic costs.
But the amount of CO2 is getting down. I'm trying to look for positives here, and if I was a big-time greenie, I guess I'd call that a big-time positive. I didn't get much pickup on that, but there you go. Session lows for the Dow, down 600 points. That is a 3% drop. Google is now down 24 bucks, barely above 1,000. Amazon's picking up $17. Big tech. Microsoft is back. We had a small blip up. Now it's down to 139. Apple's at 243. Scott Martin, I got to say, as I look around, I would have said that Microsoft and Apple represents a lot of value 2 years from now, 8 months from now, a year from now. Where am I going wrong? Amazon and Apple. I'm sorry, Apple and Microsoft.
You're right on track, and I would add Amazon to that list. I'd add Google to that list, Stuart, as well. And that's what we have to remember as investors is these are opportunities really long term. And it's so funny because, you know, we manage money for a lot of clients, and everybody wants to buy stocks when they're at all-time highs, when they're going up every day. But the reality is we want to buy stocks when they're appropriately valued or even cheap, I think, in some cases. And that's getting to the point now. But nobody wants to touch them. So we have to remember that when we look at these great tried-and-true companies, you mentioned Walmart earlier in the show. Costco is something, Stuart, that we own, that we've loved and talked about on this show over and over again. I mean, who would have thought the sign of the times that, you know, the 50 boxes of macaroni and cheese, the 40-pound bag of flour would actually come in handy one of these days? It is, and you can find those at Costco. So those companies are companies that are going to be around a long time and should be part of your portfolio. And adding to them here at these lows or at these very low levels is a great way to accumulate wealth.
That reminds me of the survivalist days 30 years ago, when we had bunkers and you were buying the dried food to make sure you're okay in the coming cataclysm.
Yes.
Okay, sit up straight there, Scott. You look like you're slumping. All right, news on Disney. What do you got for me, Susan?
Okay, he says that to me all the time, Scott. Now, we have Disney trading at more than 5-year lows at this point, 87 bucks from what I see on Disney valuation. And they just came out saying that the impact of the coronavirus will have numerous impacts on their business. We talked about the theme parks, Disney World. Virtually every Disneyland, Disney World has been shut because of coronavirus. And they're also talking about the creation as well, since we know that they have a new streaming service. They build a lot of their own content for movies, of course, and also the TV shows that go on the streaming service. And they're saying that creation has been impacted, and they're concerned that this will lead, the COVID-19 will lead to changes in consumer behavior. So what does that mean for the theme parks? What does that mean for going out to movies and watching them on the big screen in the future?
Well, yeah, but look what it means for the stock, Susan. I don't know whether you can see it, but Disney's at 85 right now.
More. I think it's close to almost a decade low, actually, because I was looking at the 5-year chart on that.
Gotta be. Is that a buy?
I mean, you know, eventually we'll get through this. I mean, at what point do you start saying, oh,
yeah, the parks will reopen at some point.
They will.
The movies will be out there again at some point. $85 a share on Disney.
So also Disney goes on to say that there could be an impact on the cost of borrowing, whether that's in a good sense, in that they can get cheaper loans and maybe have credit to tie them over until people return to the parks and start watching movies once again.
I just got it. I just see that some big-name, brilliant companies, their stock price is so depressed. I have to believe that they'll come back.
It's not like they suddenly blew their operation and they made some terrible decisions. And you've got to believe at some point we will come back. We will get back to whatever normal is. And then you can ask yourself, Disney will reopen the parks. To your point, will go bring out more movies and so on and so on.
As Treasury Secretary Mnuchin told Maria earlier this morning, we will go back to a normal world.
But
Don't know when.
There will be a psychological impact for consumers, no doubt, but for many companies. You know, do jobs come back? Do companies, knowing the world is so risky with this black swan event, do they want to take on so much debt? Do they want to over-leverage themselves? They've been enticed to do so because rates have been so low, but is that the best thing to do going forward? It's a psychological impact.
Yeah, I see the point, but I do believe the American economy simply will not disappear. It will come, as Treasury Secretary said, it'll come roaring back at some point. I don't know when, but it's going to come back.
That's the key, isn't it? When?
Lots of companies are offering relief to their customers and employees. What have you got on Ford, Lauren?
So Ford is offering customers who make new car purchases 6 months relief for their payments. The stock is down. It's down almost 8%, about an 11-year low right now. They've also suspended their dividend, and they've drawn from 2 credit lines, so they have now about $15.5 billion in additional cash. Those are the moves Ford is making so they can A, have cash, and B, give some of their customers peace of mind.
Okay, now we've got to say goodbye to our 2 market guests, so I'm giving them a last chance to chime in here. First of all, Mike Murphy, what have you got? Last words.
I think you want to look at quality names. And, Stuart, keep an eye on dividends. You mentioned McDonald's. The dividend yield there is almost up to 4%, down $100 off a recent high. That's where you want to start putting money to work in names like Disney and McDonald's.
Scott Martin, last word, please.
Yes, watch credit markets here, Stuart. If credit markets start to shore up, get more liquid, you don't see as much falling in, say, corporate debt, high-yield debt, that's where the bottom starts to come in for equities.
And that's what we're looking for. Scott Martin, Mike Murphy, both of you, thank you very much for joining us. Much obliged.